Welcome investors, and hope you're doing well. Please remember to like the video and subscribe to the channel. Let's get into this clip.
I want to talk a little bit about financial advice and how that side of the business works, because Vanguard is at least perceived to be exclusively a mutual fund company. So a lot of individuals are trying to figure out how to put a portfolio together. It's helpful to hear the number of funds that you would put into an account for an individual, and it's relatively small and should be manageable and a decision that an individual can make on their own. But yet many people come to their finances and say, you know, please, Jack, just do it for me. Like I'll literally give you the authority to make all transactions in my account. I don't want to know anything about it, which of course sets up a lot of people to be taken advantage of by financial advisors. So what do you think of the financial advice side of the decision-making process for an individual?
First, let me just take this, maybe you think it's kind of a nuance, but I got a letter from a shareholder the other day saying, you keep telling me you only need 3 or 4 funds, why do you have 170? And I took the simple example for him. We have like 60 bond funds, 60. Why is that? Well, we invented or created or developed a system of, you tell us the maturity, how much risk and how much income you want. So you get short, medium, and long, and also a couple of variations around that. And then in the municipal area, you only have the funds themselves, we do in different states. And then we get some bond index funds, and we probably have 60 bond funds out there. So an investor either has to know and do the math. Should he be in municipal bonds or in taxable bonds? Very important decision. And right now, municipal bonds look very attractive simply on the numbers, those kind of numbers. And then you have to decide how you want to balance risk and return. Obviously, the higher yields, no matter how depressed they are in long bonds, but the greatest risk is there. And the lowest yield is in short, but the greatest principal stability is there. So those are decisions investors really have to think a little bit about. It's not just, you can buy the bond index to be sure, and that turns out to be an intermediate term bond fund, in fact. And that's perfectly satisfactory. But we kind of nuanced ourselves to death a little bit. And you should, in terms of taxable and tax exempt, deal with that issue. And I'd say, to simplify, most investors should be in tax exempt, just because they yield significantly more than treasuries, even before you take into account the tax exemption. So I think they're attractive, and maybe you want some treasuries there as your bulwark, and you can buy a treasury bond fund. And it gets to be a little nuanced. I think the interesting question is, if you want financial advice, how much should you pay for it? Let me give you an interesting little piece of math. I look at the stock market investment return as a 2% dividend yield at the present time, low but not nearly as low as the 1% we were, and a 5% earnings growth. That's a 7% investment return, and over the next 10 years I don't think it's going to go up because of higher PEs, or down because of lower PEs, not down much anyway, and so there won't be any speculative return by my reckoning. So we've got 7%. That's nominal. And so we go to real. And if we're lucky enough to get 2% inflation, that's 5. And the typical fund manager is taking 2. That's 3. And if you give a 1% to an investment advisor, that's a third of 3, and you're down to 2. And if you're a fund picker, you lose around 2% by jumping on the latest bandwagon. And 2% minus 2 is a number that I won't recalculate for your audience.
Well, it's a reminder of Warren Buffett saying that the financial services industry is an extractive.
Sure. The economists call it rent-seeking industry. Of course it is. It has to be. And it has to shrink. It has to get its costs down. The trading volume has to come down. And a lot of mutual funds are going to have to fight. They're going to be cash cows. The big mutual fund companies are fantabulously profitable. And they can't change what they're doing and do what we do, because they would not be profitable to their owners. Either financial conglomerates, or all those partners at Capital Group, or the Johnson family up at Fidelity. Their wealth is like 20 billion or something, putting the family all together. They've done great in this business. Whether their shareholders have done great is the question that interests me. That's where we should be focused. And the financial conglomerates, the same thing. They basically tried to destroy this industry. They own 40 of the 50 largest fund groups are publicly held, and most of 30 of them by financial conglomerates. And think about buying a fund that's run by a financial conglomerate. Why did they buy their way into this industry?
And why are there more funds?
The Golconda. They wanted to jump on the wealth bandwagon of managing money. And they will accomplish that whether by hook or by crook. If their return capital threshold is 15% and they pay $1 billion for a mutual fund company, they're going to have to take out $150 million a year. And it's easy.
Excellent clip. Well said by Jack Bogle. The question is, why do active managers continue to underperform passive managers, even in years when the markets are pretty much up? Check this out. If there ever was any year active managers should have outperformed the passive, it should have been 2020 and the first half of 2021. But check this result out. Of the nearly 3,000 active funds Morningstar analyzed, only 47% survived and outperformed their average passive counterpart. So that said, roughly half of the managers fell below the passive managers. And the question to ask is, why is that the trend? Why do they continue to underperform? And the answer is right here, guys. Why can't active managers outperform? Okay, 3 reasons. Number 1, when you are trying to time the markets, you have to be right twice, when you buy in and when you go out. Number 2, if you give your funds to an active manager to manage, don't forget the high fees and trading commissions that eat whatsoever performance you might be seeing. And finally, most investors are getting more and more sophisticated. Unlike the past where we had the bulk of investors being retail, right now we have a lot of institutional investors. With that being said, it's pretty difficult to just hand your money over to a manager and go to bed expecting him to outperform the index, particularly if he's an active manager. Now let's hypothetically imagine that you have 40 years to retirement and that you are blessed enough to have $10,000 to start your investment. With an average of 10% yield that we've seen historically in the US markets and an assumption of just $1,000 deposits every year, this is what your future value comes to, $895,000. It's shocking because you start out with $10,000 and you barely make $40,000 in contribution, yet over that period you are getting nearly $1 million. In fact, if you leave those funds for just 5 extra years, at 45 years, you will see how crazy the future value jumps to $1.447809.67 million. Now check this out, guys. The power of compounding is what stands any long-term investor out of the pack of investors who always try or attempt to beat the market. Now, if managers are falling short of beating the market, then you can imagine that most retail investors are definitely falling short as well. So perhaps one of the ways to become a millionaire, or at least start out the journey in 2022, will be for you to educate yourself financially, which this channel does pretty much by uploading content from the best investors in the world. And secondly, to consider investing in index funds or ETFs that do not try to beat the market and eventually fail to do so, but rather try to mirror the market and gain the market performance over a very long period of time. And even if you do not have this start out amount of $10,000 or $1,000 periodic deposits, putting in whatever amount you have and allowing it grow over time in a passive fund that generates an average of 10% will still lead to a future value that will push you toward the millionaire status. But remember that this is not financial advice. These are just educational materials for your learning. Thanks for watching, investors. Please remember to like the video and subscribe to the channel for more content like this. Cheers.